Okay. I think this next provision is potentially very favorable to small businesses. Again, it does apply to fairly small businesses, but to the extent that you can't use the expensing provision or the opportunity credit because you're running losses or you think you're going to run losses, the stimulus bill provides a change to what we call the net operating loss carryback rules. Under current law, or previous law, a net operating loss for tax purposes can be carried back 2 years or carried forward 20 years. And you may have, I think the administration says there may be situations where we're going to see people have losses in 2008, maybe in 2009 because of the economy, but we're in pretty good shape up 3, 4, 5 years ago. So they were, paying tax in those earlier years. What they've done is said, we'll let you carry that loss back up to 3, 4, 5 years, again, electable by the taxpayer, versus only 2 under current law or under pre-act law, and effectively recoup some tax that you paid in those earlier years through this carryback. The caveat is that it applies to fairly small businesses, and then there's a $15 million average annual gross receipts test. And that test says, I look at my gross receipts for the 3 years preceding the year of the loss, and if my average for those 3 years is $15 million or less, then I qualify. If it's greater than that, I don't qualify. I'm subject to the same existing 2 years back, 20 years forward rule. The other caveat is I can't have a business that's not engaged in an active trader business. So I can't be a passive in nature. I've got to be active trader business, generating a loss in 2008, $15 million in average annual gross receipts prior 3 years. I can look and see whether I can carry that back. And we're going to be looking at that for all of our clients that are operating in the regular corporate environment. Those are the entities that would qualify. I will point out the last part of the slide. It says an active trader business conducted in or through a corporation, partnership, or sole proprietorship. So if you've got a corporate entity sitting on top holding an interest in what would be a pass-through entity, partnership, an S corporation, because those are pass-through entities, they don't pay tax, that loss, if you will, would flow up to the regular corporation. That qualifies. And I can look and carry it back. Even though the active trader business is not conducted at the entity that is per se carrying it back, it is owned by the entity that's carrying it back. Okay? Okay. A few other provisions. These are the ones that even make us tax accountants glassy-eyed as we try to read through the details. These are pretty narrowly focused provisions. One of them, however, deals with debt forgiveness. Under general rule, if you owe money to somebody else, another business, and some of that debt is forgiven, you would typically have what's called cancellation of indebtedness income. You'd have to recognize that income in the year that the debt is canceled. You basically have gained an economic benefit by the virtue of the fact that you don't have to pay all of it back. This provision says that if I have what's called a debt for debt exchange, or I repurchase my debt at a lower face value than what the original debt says, I can elect to recognize that income, not immediately in the first year, but over a 5-year period. And in fact, I can stretch out for 4 to 5 years when I have to begin recognizing it. So you can kind of understand the incentive here, given where we are in the economy with lots of debt out there and people unable to pay it, and going, okay, if you'll let me renegotiate that, if you will, I'm happy to do that because now I've got a fairly significant tax incentive to do so. And it's not going to burden me nearly as much as it might have otherwise if I had to recognize all that income in the very first year that I had forgiveness.
So, can I ask a question about that?
Yes.
So is the debt the advantage for the debtor or the debtee?
It's going to be, the question is there an advantage for the debtor or the debtee? The advantage is really for the debtor, the person who's being relieved of some element of the debt.
So would that apply to houses which are short sale? or foreclosed? Because they still have to pay taxes on that. Is that in regard to taxes?
You know, that's a good question. The question is, does it apply to the house foreclosures? I don't know exactly whether it does or not. The language that I read, and I didn't get into the details, deals with what's the issue price, the original issue price versus the new issue price.
But that's all relative to corporate debt.
Well, I think the provision is for businesses, but I could have a situation where I'm holding that kind of a mortgage in a corporate solution that might, in fact, I don't know for sure.
So they own a business, a commercial building?
Sure.
Yeah.
Yeah.
Yeah, it is a business-oriented provision, but that's not to say that the rules are not widely enough or broadly enough defined, or that you can't fit some kind of a scenario like that into it. You'd want to look at that to see whether or not it might in fact apply. Second provision deals with what we call small business stock. Current rule says if I sell small business stock, and it's stock in an entity that's got, I think, I wrote it down, 50 million or less in gross assets, and is conducting an active trade or business, that I can exclude up to 50% of the gain on that stock sale. They've increased that limitation to 75% for stock acquired beginning with the date after the date of enactment, so February 18th through the end of 2011. And then going forward, if I have stock that I acquired in that time period and I sell at some point in the future, the provision would apply to allow me to exclude 75%. Again, the incentive is to get people to invest in small business stock and to boost the small business community. S-Corp built, I'm sorry.
What about options?
The question is, do options apply? I didn't look at that rule specifically. I don't think it does. I don't think the definition of qualified small business stock includes options, just by definition. But I'm going to have to look to make sure. I don't think it does, though. S corporations, there's a fairly, I don't know how widely applying this provision is, but the rule relates to an entity that at one point in the past was a regular corporation, C corporation, and it converted to an S corporation. So now we go from double layer of taxation to a flow-through entity. General rule says that if I do that, and that S corporation had what's called built-in gain, in other words, its value was greater than the basis in its assets, if it were to sell any of those assets over a 10-year period following the time that it converted to an S corp, the S corp itself, even though it's a pass-through entity, would have to pay tax on that built-in gain that was recognized. This rule simply moves that 10-year period back to 7 years. So I don't have to effectively wait as long, if I'm an S corporation, to sell some assets that might have appreciation built into them when I converted. I can sell them after that 7-year period, if 7 years have passed, generate some working capital, if it may be, and not pay tax on it. Obviously, the intent is, again, to free up assets within that environment that might otherwise be held on to because nobody wants to pay the tax. They would otherwise wait 10 years. I now don't have to wait quite as long. Final provision deals with estimated taxes for individuals who have small businesses. General rule says I pay estimated, say I'm an individual and I'm conducting a business and I file that business on a Schedule C in my individual income tax return. General rule says for estimated taxes I've got to pay either 90% of the amount of my tax before I have to file or I'm subject to a penalty, or there's a safe harbor rule that says if I pay 110% in estimated taxes of what my prior year return showed, I'm safe. It's called the safe harbor rule. They've dropped that safe harbor provision to 90%. So now I can look at my situation and go, okay, what do I think I'm going to owe? And I'm not sure. Well, instead of having to pay 110%, I only have to pay 90%. The caveat is that I have to generate at least 50% of my adjusted gross income on my individual return from this active trader business that I'm conducting and operating through a Schedule C. A little bit of relief, again, targeted to business, particularly small business. Something to certainly look at.